As a result of the growth characteristics of the economy here and the stability, the perceived stability of our economic system, the U.S. has been the beneficiary for quite a while now of lots of capital finding its way here, which has been a great benefit to the U.S. If you look at how the market is reacting and what the market is saying based upon what policy is now, you're seeing for the first time some very unusual correlations in markets. And correlations in markets usually tell you something, right? In this situation that we're living through now, you're seeing, I think, a different type of correlation change. You have some underlying concern about potential recession, slowdown in the economy. Normally what you would see is interest rates going down. And what we're actually seeing is a change in the structure of the yield curve. So we're actually seeing long-term rates go up. So what is that telling you? It's telling you that the markets are concerned about inflationary effects of what's happening. The markets are concerned about maybe people moving away from US-based assets or dollar-based assets. So is that going to affect our ability to finance ourselves? It's not clear now what the Fed feels they need to do as a result of the potential of kind of inflationary factors as a result of large tariffs and things like that. The other weird thing you've got going on right now in terms of relationships, if you see bond yields going up, treasury yields going up, it usually attracts capital to the dollar. That's not happening. The dollar has basically been under a lot of pressure. So you've got an emotional reaction generally in terms of people's confidence. If you look at what's happened with the banks in terms of the banks taking a step back or being constrained in terms of being able to be capital providers, the private capital pools have stepped into that and are providing that. The last decade has been hugely transformative in terms of how capital is getting to the most interesting companies in the world and how those companies are being owned, how those companies are being governed. We've absolutely been the beneficiaries, all of the firms in this space, of that tailwind in terms of capital coming to firms like ours to get deployed into these private market opportunities. I don't see that changing. It ebbs and flows. But if I were to sort of draw the line out to the future in terms of will private capital continue to play a critical role in the provision of capital globally, I see that only increasing. We always have a high level of engagement with our portfolio in terms of both driving value creation, but also partnering with our CEOs, entrepreneur founders, our management teams. In times like these, that partnering is really valuable. There are actually over 1,000 companies in our ecosystem across our private equity business, our credit business, our real estate business. Looking at that portfolio, what we see is that what we think of as the first order exposure to tariffs is actually fairly minimal based upon the sectors that we've been focused on, the types of companies we invest in, the themes that we felt were kind of secular growers. The exposure is actually relatively modest. Now, the second and third order exposures, which are if we fall into recession, what happens with the consumer, et cetera, those are another question, which obviously we haven't seen fully play out yet. But when you start to look at the credit side of our house or the real estate side of the house, you're also seeing something slightly different. Credit markets through this period have actually acted fairly rationally and are functioning pretty well. If you look at credit spreads as an example, which is always a measure of how people perceive risk, particularly in the corporate sector, credit spreads have widened, which you would expect as a result of this overlay of potential inflation, stagflation, recession. But when you look at the distribution of credit spreads over time, credit spreads on average are still actually fairly compressed. So does it look to us like, we're sort of heading into a distress cycle or a default cycle from a credit perspective? Right now it doesn't. And deals are still getting done. In other words, companies are still getting financed, deals are still getting financed. And so things are behaving relatively rationally. The other thing that's really important in times like this is to stay focused on where the opportunities are being created. And you only see those if you're deeply embedded in these markets, deeply embedded in these industries, and have developed long-term relationships and dialogues with companies, CEOs, management teams, where there's been a degree of mutual respect as a result of kind of developing these relationships over time, where they're looking to partner with a private equity firm, they're looking to partner with an alternative asset management firm, where our capital is solving a problem, but we're doing it in a way where we're partnering with them, looking for the opportunity to create a win-win with those companies. From a leadership perspective and running a firm like this, when you go through these periods of a tremendous amount of uncertainty, it's a certainty that if you're feeling a little bit offsides or nervous or uncertain, pretty much everybody in your organization is feeling the same way. Hopefully you can remain in a place where, you're a little bit calmer. In terms of your touch points in an organization and your contact with people that are working, day in, day out, kind of in the trenches, really reinforcing the level of contact and the communication, sitting down with people and talking to them about what's going on in your business. All of those things are very important in moments of uncertainty and crisis. And one of the things that I did on the credit side, I got together all of our portfolio managers with our head of risk and had a call where we were just all on the phone together, just talking about what are you seeing in different markets, leading from the front, doing things that may seem very simple, but are enhancing communication, I think is a very important tool and a very important discipline in times like this.